Hello everybody and welcome once again to Market Thoughts. I am Will Hassel and I'd just like to start off by saying Happy New Year. Welcome to the new financial year, and with the new year comes new changes. If you missed my last video that I did about 2 months ago, I basically talked about how I'm changing my video format from pretty much a week-to-week thing where I, really dove into weekly moves in the markets and stuff like that to longer term, because a lot of the times during my market videos I would talk about stocks in a longer term, and it didn't really fit with how I was going and examining each thing, like the S&P, like its 1 week move and the Russell and all that stuff. So I just wanted to, shift it to more longer term, because that's mainly what I focus on. And hopefully you guys can get something out of it, which is what I hope you guys will. Other changes is I am now a content contributor for the Financial Bulls and Captains of Capital, so I of course have to plug them in, as well as the Leaders Investment Club, into the starting of all my videos. Please, follow all the guys on those sites. They all do great work, and I really appreciate if you guys, go and check us out. So hopefully, more people can get involved in the financial markets. Hopefully more younger people can get involved with the financial markets. I have heard, I've gotten emails from people who, have said, how much they like my videos and stuff like that. I did post a presentation that I did for Fox on Stocks a while back about first starting off with investing, because a request that I had was to make a video about people, for people that didn't really know how to get started with investing. So, and I had that presentation, just saved on my computer, so I posted that. So please do check that out if you're wondering how I got started long term. Some of the processes that I think I do go into that in some of these videos, but it's mainly more about market outlooks versus how to invest, like calling up a broker and stuff like that. And with that, let's get started. Here we go. Look at this 1 year chart of the S&P, the S&P ETF, the Spider ETF. If you notice, I do have my 1 year, 1 day chart. I've got multiple moving averages, 50 in red, blue is 200, and yellow is 21 day. I got my volume, and now I have a new addition to my charts, which I actually am really starting to love, and it's historic versus implied volatility. I actually posted a chart on both Twitter and StockTwits a little bit back about Apple, and we'll get into that, because historic versus implied I've begun to love, just because of it shows a lot of great timing elements to the market, and also helps you, think more about market changes in terms of perception. But as we can see, S&P had a great run this year, about 14%. I don't think I beat the S&P, but you know what? I'm growing my money, and that's all I'm happy with. If I can continue, if I can have, a year of no down months versus beating the market, I'll take no down months versus, a volatile year and eventually beating the market like within that year. I like steady growth in my money, so if I can have no down months, I will be extraordinarily happy. So S&P had a great year. We had a little bit of, trouble throughout the year, which you can actually tell by these volatility spikes, which is why I love doing this implied versus historical volatility. Start off the year with some, right over here, with some foreign troubles, Crimea, Russia invading Crimea, and you can go and actually see the implied versus historic volatility here. Got a pretty good spread, 6.6% spread. What I like using this for is it actually helps you figure out when some of the turmoil is done. Then March, April, we had a lot of tech stocks, a lot of high PE stocks kind of start to falter, start to worry. It was pretty volatile the first half of the year or so. Uptrending pattern, but pretty volatile these first couple of months, and then continued the uptrend. Summer, we kind of sold off once again Russia fears, that some Russian separatists took down a jetliner. And then after that, it was pretty much smooth sailing right up until fall. fall out of almost nowhere. We had pretty much a 10% correction, intraday 10% correction, not closing 10% correction, but nonetheless, I mean, it was pretty scary. It happened relatively fast too, from what were all-time highs. As you can see here, it was a pretty sharp decline. It clearly broke through the 200-day moving average, and then sorry that these things keep popping up. What you can see here is why I like using implied versus historical volatility so much. It's that during this whole process, the spread started to widen quite a bit, right up until here. And if you look, it's this candlestick. I know it's a little hard to see, but I was just catching up on all my little details. The spread widened quite a bit up to, just about 8 points. And that's the widest that it's been this entire year. And another thing to look at when you're using implied versus historical volatility is that implied is over historical. When implied is over historical, that means you normally have greater volatility than historical below implied. And you can see that right here, right as we get right up here, right when the spread is the widest, it was this candle right here, right before we almost bottomed. And if you would have bought there, you would have made, you would have taken a little bit more pain, but hey, you would have gotten it almost nearly right. And then right here on the second little, almost the biggest spread, there is a quick 7 points. That's when we actually bottomed and it started to go up. And as we noticed through this entire uptrend, historical was greater than implied, meaning very, very low volatility. And then right up until we got here, which is the end of the year, which we got a little Santa Claus diss rally, a little Grinch rally, if you would say so. And the spread widened again here to just about 9 points. So there's another big wide spread. Downturn. The spread continued to widen. There we are at another 8 points, and that's actually right at the bottom. And if you would have bought there, if you buy these little big gaps, you have to make sure the spread is really wide. Though you can't go, oh look, it's only 5 points. It's got to be bigger than the mean. And I wish that Trade Monster had a moving average for it. That would be awesome, but unfortunately it doesn't. So you just kind of have to figure it out as you go along. And it's actually been a great little tool for me, and I'm going to show you on Apple in a little bit. But these are some of the moves that I think implied versus historical volatility also actually helps you think bigger term when you go, look at how, just look at throughout this entire up decline how little volatility there actually was, but there are still actually some pockets of rather big volatility. Going into some of the things that happened this year, I'm not going to go into the NASDAQ. I'm going to go into XLE, which is actually one of the, excuse me, I've been sick the past couple of days. Probably going to be one of the better things to look forward to in this new year. Oil had a massive decline. I think it's OSU, that is the United States Oil ETF, yeah. And as you can see, just massive 30% decline, huge volume. This sparked off a lot of concern about oil companies, about disinflation, about slowing economics, but also good for the consumer, all this stuff. And this is actually an interesting case with the historical versus implied volatility. Here you have a massive spread, and it actually did kind of call the bottom right there, but not entirely. If you look, volatility actually increased, continued to go up, and once again, another big spread. This time, as you see the crossroads, that's when the price started going up. XLE is actually a way that I am thinking about playing the energy space. I kind of want to buy it. I'm not exactly sure, though. I kind of want oil to stabilize a bit. We're actually coming up on the $50 level. If it breaks through there, things will get very interesting very fast. The energy sector, this is a great opportunity, but for me, I'm not sure exactly where. If it tests the recent lows, which were 72, I think you definitely buy it. But right up around here, I feel comfortable with it because historical is above implied. But at the same time, I am still worried about what macro risks there are. OPEC can come out of nowhere and decide to decrease production, increase prices, all that stuff. So it's still something that you have to watch. But in terms of longer term, I feel like that's going to be a great place to buy, and I'm once again thinking about that. A sector that I'd like to highlight, again, as we're talking about the disinflation, is XLU. And those of you that follow me closely know that I am long XLU. I have been long XLU, as you can see here from my trades. The best performing sector in the S&P was XLU. It yields 3%, very, very low volatility, as you can see here, except for this little spike right here. I have no idea what that's about. Probably one of the sectors in the XLU. I actually like holding the XLU. It's a very small percentage of my portfolio, about 4%, but 4 or 5%. But it's a good hedge against inflation, and it yields 3%. It's a good hedge against disinflation. Not my apologies. And I think if you own it and you want to make the bet that disinflation will continue, slow growth will happen, I think that is definitely the place to be in. I am a little concerned about just the run that it's had, but like I said, if it's only 4% of your portfolio, you don't really have to worry about it too much, depending on how you weight it. But I like the utilities. I don't see why you don't own it, if not just for the dividend, just for that 3% a quarter. I mean, you can go and make 12% if the utility sector doesn't move anything. Some other stories. Apple. I actually got long Apple because I couldn't resist it at these levels. I actually started to test towards those levels, but I actually used my historical versus implied volatility to go and buy it there. You go and you look at some of these big correlations that we have here. This spike right here, which was a pretty steep little nod. Whenever the spreads widen, we don't pay attention to historical being above implied because it's stuff like earnings. Once again, earnings. But we do pay attention when implied is greater than historical. So like right up here, October, we had the spreads. And right over here, actually, we had pretty wide spreads once again for the historical over for the implied over the historical, about 11% difference. And actually, we're starting to test that again right here with a 10% spread. So it may be time to actually buy Apple right here, just because of where the historical versus implied spread is. We are going into earnings, so that could be priced in a bit. But I mean, if you're looking for a way to kind of time it, this is it. I think Apple's going to continue to do well. If interest rates do rise, they're going to get appreciation on that cash that they have, and it's a lot of cash. I think they'll continue to pay out the dividend. I'm not sure how the iWatch is going to fare out, but I still think they're going to do well. I own the stock. It's a good long-term play. Those of you know that I kind of dislike Apple, but eventually as a portfolio manager, you just have to buy it. And I mean, I think it's going to continue to grow, not as much as some other companies, but I also want to highlight Google. This is Class C. I'll just do, I'll do the Class A shares just because Google had an interesting year. This has been a stock that a lot of people have tried to highlight. Once again, huge spreads starting to continue here in the historic 17% spread, 17-point differences here, and you can see how that can go and affect it. A lot of people say that this is a great value play because it's selling at earnings are growing 20% per year, but the PE ratio doesn't really reflect that. It's actually a great value play. It's going to continue to grow. I think so too. It's just I don't know when to play it. It's in a spiral right now. I don't know when I can get in or out, just based on cheapness of it. So, I mean, I think it's one that if it gets to a certain point, you buy, maybe below 500, right at that 500 level, which has been key resistance for a while. I think that's where you buy it. I mean, it's a great long-term play, but you have to be careful. It is a very highly priced stock. I can only pick up a couple shares just because of the way I manage my portfolio, that I don't make sure, everything is equally weighted. Going into some of my other things that I've liked this year and will continue to like is Disney. I mean, talk about a great run company. It had a great year this year. Once again, if you would have bought it here like I did, as you can see here, I bought it at 82, which is right here. I actually bought it 15th. So I bought it here. I bought it on this day, which is pretty much the bottoming day, and almost right when the spread was the widest in terms of volatility. And as you can see throughout here, it's just performed really, 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 really well. I think it can easily go to 100. You got to remember they're opening their Starbucks. I mean, not their Starbucks, their Star Wars franchise this year, and they still own ESPN. I have the feeling ratings are going to be great because of all the bowl games. This is just one of those names that you almost have to own. It pays out a decent dividend, if I remember correctly. The quote. Let's find where that yield is. Yeah, 1.23%, not that bad. You get paid a little bit to wait, but it's also still a great company. Other names that I like, Blackstone. It is structured as an MLP, so that there are very, 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 you have to make sure you know your tax, that you have to go and pay on that, and you have to be careful about that. But once again, here with the historical versus implied volatility spread, if you bought it right there, right when, it was, I bought it almost close to the bottom as much as I could, and this stock has been a massive winner for me. The dividend was right in here, and it's just been taken off. They've made a lot of money from selling real estate. They're starting to go into the oil space to go and bottom fish. But if you went here right where the spread was almost 40 points wide, and you would have bought it right there, you would have made a lot of money like I did. I mean, not a whole lot of money just because of the size. I got about 50 shares, but still, you're looking at, I think I have something like a 13% return, and I still think that they're going to do great. I think the asset managers are really going to do well. BlackRock being another one of them. I like Blackstone just because they have a 5% yield, so I get paid to wait. They do a lot of great moves. They're starting to sell. They sold a lot of real estate. They're starting to get into oil. They're just doing all the right things, it seems like. And they're one of the best in the business, and that's why I just love them as a company. Under Armour, one of the stocks that I own. Like I said, historical can sometimes go, when you see these huge lines, it normally means earnings. So earnings. But then right through here, we had the huge spread. And Under Armour has kind of stayed flat through here. Once again, the spread's starting to widen a bit. I think with earnings, it's really going to show off, just how well they did. I'm going to assume, I'm just going to wait till earnings to see exactly how well they did, but I feel like it's going to be great. They had great expansion into overseas last time. So, I think that's going to continue. You're going to have to watch revenues. They did spend a lot of money on sponsorships, but I feel like that's going to pay off as well. You're just going to have to pay attention to revenues, and just really hear what they're going to say. They're a consumer name. Hopefully lower oil prices have helped them out. Hopefully this was a good Christmas season. That's going to be something to pay attention to for a lot of them. I'm going to highlight Nordstrom's because they're one of the best retailers when it comes to Christmas time. A lot of great brands. They made a great acquisition of they made a great acquisition of Trunk Club, which is something that I've used before, which is pretty much this kind of personal shopper but sent to home thing. I feel like they're going to do well, kind of towards the mid-luxury side, which is the same thing for Kors. I still own a bit of Kors. And when I did my mall walks, I know it's been an ugly chart. I should have sold some. I actually did sell some when I had a bigger position. Should have sold some. I doubled down here, which was stupid because it just continued to decline. It's been doing nothing for the past couple of days. It needs to break out of 80 for it to go anywhere. But I feel like this holiday season is going to be great for them because when I walked the malls, both before and after holiday season, I saw none of the core stuff marked down. Brian Solzy said the same thing. As opposed to Coach, which I saw like 25% off and all this stuff like that. So I think Coach is probably going to be one of the is going to probably be heavy hitted just because of the compression of margins versus Kors, which actually has some of the highest margins in the luxury space, and their decline has actually slowed in their margins, which used to be a big thing during the earnings report, was the compression of margins, but it hasn't happened that much. I mean, look at these huge volatility spreads too, my God. I mean, we're talking 30 points. I don't like Coach at all. I mean, you could play it for the turnaround, but I'm not a huge fan of Starbucks. Starbucks, yet another company that for a while just felt like, right through here, just felt like it was just, going full speed ahead. This is when they announced, this is when they had their shareholders meeting, when they announced all their new roastery stuff, their basically their battle plan that they talked about during earnings about how they're going to start doing their roastery. The roastery's opened up. It looks like something out of Willy Wonka and the Chocolate Factory. It's gorgeous. It's beautiful. It's a great way to go and target the higher end luxury coffees that Starbucks can pretty much be a niche player in. This is the largest coffee company on the planet. They control a lot of the market share. I know what you're saying. What about coffee prices being one of the, gaining the most this past season? Well, Starbucks does great hedging on their coffee. Dairy is actually where they run into more commodity cost, so you got to watch the price of dairy. But other than that, I mean, this is a crackerjack management. Howard Schultz has led this company to just expand out of the yin yang. They are a great company. I worry about food and how well that's doing. They're doing a lot of expansion towards there, so I just worry about, is that story actually going to play out? And during earnings, I'm going to pay attention to how food went. They're trying to expand more into lunch items and stuff like that. They want to be the third stop between work and home. They want to be this kind of area where you can grab something to eat, you can grab a coffee, you can grab a cocktail in some locations, and just be a very casual place to be. I don't know how well the food is going to work out. Like I said, we're going to have to wait to see in earnings. This earnings season is going to be very, very interesting because of how gas prices affected all these companies. Are there any companies I'm thinking of? Qualcomm, which is a company which I like a lot. They actually did a settlement with the Chinese in their licensing business. I think this is a story where you could actually play the turnaround to an extent, because, like I said, during this earnings report, they did worse than expected earnings, but it's mainly because of that they couldn't get the margin, their licensing payments from certain Chinese companies. And I think if you want to play a good tech company, which, I mean, the reason why the Chinese were suing them was because they were in violation of antitrust suits, which, if your business being a monopoly is good, not good to be, that you get sued for antitrust, but I mean, it means, hey, they got a lot of business. And ever since this kind of capitulation move down to 67, if you would have bought right there like I did at 69, I mean, it's been a great little return. It's been a $7 return. I think, they're going to do well this year. And if it can just fill in this gap a little bit more, if it can breach, not that candlestick, this candlestick, if it can go past 76.50, I think this thing can take off towards those other highs where it can fill in that gap as well. It's got a little bit of broken technicals, but fundamentally this business is rock solid. They got a 2% dividend, and they're just doing, once again, another company that's just doing all the right things. I was just trying to remember what other, stocks I have to go and, talk about. I do love it when you guys send me stocks to go and talk about. I can go and run through what I think about, some of these stocks all the time. I just go through my portfolio because it's easy for me, because it's all stocks that I know very well. I do go and highlight stuff like Google, like I promised I would, because it's an interesting story, or XLE, because it's, interesting. Send me in stock, tweet me, hey, I want you to cover this on your next video. I do them kind of randomly, I know, but if you go and you send me an email, send me a tweet that says, hey, I'd appreciate if you, talked about this stock in your next video, I of course will oblige you. I've done that for some videos in the past. I've talked about them, so please just continue to send them in. I'm just going to finish this off on a couple macro notes. The U.S. did print a 5% GDP number in December, which is actually really fantastic, considering this time last year we were, this coming quarter last year we printed a negative 2% GDP growth. So, if we see another print like that and the U.S. starts to really move and bonds yield rates start to rise with a strong dollar, I think we're going to be really, really, really good for this year. But a thing to watch is, I'm going to just highlight the TLT, because the bond market, when everyone was expecting yields to rise, they fell. Bonds were a great asset class to be a part of. I wonder if this would own. Yeah, since they're bonds, they opposite way of the stock market, so you probably want to go in when the correlation is low, go and buy it. Or I wish I could invert this. Then I could really, because it's pretty much an inverted S&P chart when you think about it. And, pay attention to bond yields. Bond yields do matter. The fact that we are close to the year highs of 188, which if it breaks through that level will be massive. Might want to try and get a position in TLT here pretty soon. If it can break through, that 188, 128 level, I think we could definitely see some interesting things go on. We could see almost another capitulation move, probably at bond yields. In a time when European yields are at almost historic lows, which is very impressive, because some bonds like German Bunds go back all the way to like the 1600s. The bond market is telling us something. I don't know what. Is it telling us deflation? Is it telling us there's a recession coming in? I don't know, but I pay attention to them because they are a bigger market than the stock market, and they can tell us things. And I think we got to watch yields very closely. If yields start to rise, then that means people are coming out of the safety trade. They want to get a little bit more risk, because bonds are the safety play. And I think bonds are going to be something that you want to have on your screen somewhere, or pay attention to. Keep the TLT up, somewhere. Just, if you don't, I keep a little watch list called Market down here. Let's actually see if I can go in watch list. It's this little thing right here, actually, not that, but it's got a couple ETFs that I watch, like the short-term VIX Futures ETF, the corporate bond ETF, emerging markets, gold, Russell, and then excuse me, and then the 10-year and the 20-year Treasury, the TLT. Watch some of these ETFs, watch how they move, get a better sense for the macro environment, because macro can help you longer term in your investing. Because when you start playing, multi-year strategies like I do, or multi-month. When you start relying on, you start to actually rely on macro quite a bit. It's not, day trading, you don't care about the macro environment too much. Longer term, you do want to know about the macro environment, so you do need to pay attention to bonds and know how they work. I'm going to wrap it up here. I know this has been kind of a long video, 30 minutes, but, I appreciate you guys watching my videos. Please send me, stock picks, send, any comments, please send them to me. I really appreciate it. Please go follow everyone out there in the Leaders Investment Club, Financial Bulls, Captains of Capital. Visit our websites, see who we are, see some of the content that we produce. Really, go and help us out. We're trying to get out there, trying to make sure that teen investors, young investors, are actually represented well out there in the world, and we're trying to help you guys out. We're trying to, we're just trying to go and make sure that investing, trading, financial literacy is out there and prevalent throughout the world. So, the more I see some of you guys, especially if you're younger out there, or if you're first timers, you're at home gamers, the more questions and comments I get, the better, the better I know that I'm doing out there to try and, help you guys learn some stuff. So with that, I'm just going to say thanks once again. Follow me on Twitter at WillHasselWS. Email me any questions. I always leave my email and my Twitter down in the comments, down in the description of these videos. And I'll see you guys next time.